All right, well, joining me on the line today is Michael Sincere. Michael has authored a number of investing and trading books, among them Understanding Options and Understanding Stocks, which are both now in their second editions. He's also written hundreds of articles on investing for major brokerage firms, as well as the Market Watch column. Michael Sincere's long-term trader. Michael, it's an honor to have you on the broadcast today. Thank you so much for joining me.
Oh, thanks for inviting me, Jerry. I really appreciate it.
That's my pleasure. So before we get into the main topic today of options trading, I just want to first thank you for your fine work. I know I speak for both myself and many of our members and students to whom I have recommended your books to over the years. Your ability at simplifying complex financial topics is a gift, and I want to thank you for taking time to share that gift with our audience today.
Oh, thanks so much. I really appreciate the comments. That's excellent.
I mean, I can't.
It's my pleasure.
I can't tell you how many of our students have read your book and just keep it by their computer while they trade, because it really just breaks down some of these real complex topics. And options trading is just that way. In some ways, it's kind of counterintuitive, where you think about stock trading and you think, okay, well, that makes sense. I buy something, it goes up, and I sell it. But options, a little bit more counterintuitive. You got to do a little more thinking. And so that book really simplifies it. So again, Understanding Options is the book that we really recommend to our audience. So Michael, before we get started, why don't you tell us a little bit about your background? How did you first become interested in the world of investing and specifically writing about investments?
Well, I guess it started when I was 8 years old, and my father and grandfather were stockbrokers, but I bought my first stock with their help, or my father's help, at 8 years old, went to school, and then when I came back, he said I made $1 or $2. I'm like, wow. So that's, I would say, my first introduction to the stock market, that you basically are making money and your money's working for you while you go to work or play or do whatever you want. So I really was fascinated by that. And then I was a teacher, so I kind of combined both things together and said, I'm going to take a complex subject, options, and try to simplify it using my teaching background, and that's how I came up with the book. But my whole life I was interested in the stock market.
Yeah,
so.
It's not a surprise you were a teacher. I mean, it kind of comes through in the book where you have a real teaching style. So again, what drew you to options? Was it just the fact that you saw a niche in the market, that there wasn't a lot of good, simple books on options? And did you actually trade options yourself before you wrote the book or as you wrote the book? Tell us a little bit about that.
Well, okay, so what got me interested in options was, first I'd been using, obviously trading stocks. I started off as an investor and then moved to trading. And then with options, I found out that, let's say if I buy Apple, let's say it's $100 a share, it would cost, to buy 1,000 shares of Apple, would be $100,000. I found out that I could control those same shares of Apple, but for way less money, for just a few thousand. So I realized using the leverage of options really fascinated me, that for much less money, I could make a lot more money without risking so much. So that is the part that got me interested in trading options. Then as far as the book side of it, I did try to read as much as I could about options, and most of the books were either too complicated or they made it sound too easy. You could make $1 million or you'll get rich. So I decided to write my own book, and it was a challenge, because again, using the teaching background, I had to simplify some very complex concepts. Thanks for telling me I succeeded. Yeah,
you certainly did.
Yeah.
So as a fellow author, I'm just curious, a book like this, how long did this take you from start to finish to actually outline this book, write it? I mean, how long did this take?
Well, this was not my first book. My first book, it took about 6 months, maybe a little longer. This book took longer, I would say 6 to 9 months. Mm-hmm. And I do have a little secret in there that I'll reveal for the first time. I learned a lot about options, but I wasn't an expert at the level that would take would take 30 years to really learn. So what I did is I combined forces with a options market maker who was a true expert. And he went over my book line by line by line, correcting errors and giving me special insights that made the book even better. That was one of my little secrets.
Oh, that's great.
I've only revealed today.
Well, that's good to have. That's a really nice thing to have. Because I would imagine that not every single publisher is going to be an expert in options and will be able to fact check every single thing that you put in there. So that's kind of nice to have that.
Yeah, they don't. But the trick. I mean, if you're talking about writing, it takes the research is the hardest.
Yes.
And then and that takes, that can take 3 months of research. And I'm talking pretty much full-time. I mean, some people do it part-time. I'm a full-time author. So when I say 6 months, I mean I'm working on it every day. And then the real trick is the rewriting and rewriting.
Yes.
And I'll just say one more thing. Many of the errors or the way the book got better was by the readers, who I give my phone number and email, or not phone number, but my email in there. And so people have written me over the years with, finding mistakes that I've been able to correct in other editions and other publications of it. So readers have been helpful. Yeah.
The research part of the process is kind of the fun. To me, it's the most fun part. And maybe you're different on that. But to me, I tend to get lost in the research phase of a book. And that's the part that I like to spend the majority of time on,
Oh, that's interesting. Yeah, I like to research when I know it. The hard part is when you can't find the answer, and that's why I had to bring in an expert who knew way more than me. I mean, I just couldn't, get the kind of knowledge and background that he had to bring that in. But that's interesting about the research.
You're listening to the voice of Michael Sincere. He is the author of a book entitled Understanding Options. It's the topic of our discussion today. Michael, I have long promoted your book, Understanding Options, to our audience, and especially our members. As I mentioned, I found it to be an excellent introduction to the world of options. But while I was researching for our interview, I saw that you had a new book out this year, which I have not read. It's entitled Make Money Trading Options. Does this new book overlap with your Understanding Options book, or is it new material?
It's new material. This was a tricky book to write because I created a strategy, my own strategy. It was more a momentum strategy, and I basically introduced new concepts and new ideas. So what I want to do in the future is write maybe a follow-up that really would be more, maybe to a more advanced audience. But Make Money Trading Options is really new ideas. It's based on what I call a test trading strategy. What I found is that many people, they jump into the options market, but they never test. They never do any paper money trading. And so using the paper money program or a simulated program, I let the program find the winning underlying stock. And then when the test program or the simulated program finds that stock, then you buy for real. That was really the concept behind that. It's not for everybody. Understanding options is for everybody. Make Money Trading Options is for people who really want to do a more momentum type trade, I would say.
It may be a bit more advanced. Maybe they've already read Understanding Options, and that's kind of the second book to read, perhaps.
Yeah, it's actually not advanced. It's really simplified. So it kind of disappointed the people who are looking for something more advanced. It's really a simple strategy and simple ideas, but it doesn't come close to Understanding Options. And it's a good book for those who like that strategy.
I see. Okay, got it. Before we go on, I want to circle back to the writing process because in addition to being an investment writer, writing columns and things like this, you write books as well. I'm just curious, do you have like a daily number of words that you try to write each day? What's your writing process like as a full-time author?
As a full-time author, I've gone through many different things, but my latest is in the morning I do edits of material because I work on several things. I work on books as well as articles.
Right.
So in the mornings I just really devote that to editing. Now, I am not a person who can work 6 hours straight. There are people who do that. I can't. I can work for about an hour, and then I take maybe an hour break. Or I may work for 2 hours sometimes, and then I take that hour break. I take a lot of breaks during the day. So in the morning, I do the more intense stuff. In the afternoon, after lunch, I tend to do the new writing. To me, the new writing is the hardest part, and I prefer to be warmed up for most of the morning. So for at least 3 or 4 hours with a lot of breaks, I will do the new writing. And then in the night, if I am still awake or still have any functional left, I'll do maybe back to editing a little bit, or maybe do rewriting or reading what I've already written.
That's just,
how's that sound?
That's fascinating feedback. It's just really interesting to hear the process because people do have different approaches to writing. That's really interesting. So yeah, when you're all coffeeed up in the morning and you're ready to go, you're raring to go, it's more of the editing process, and then in the afternoon, you're more new writing, free writing.
Right. I'll say that first I'll say I used to watch Hemingway, and he used to get up at 6 in the morning, and he'd write till noon, and then, of course, he'd go to the bars and have fun. So that's another way to do it. You get all your writing done for 6 hours. The other thing is, I will admit, I did a lot more trading And I do more trading when I'm not writing books. Right now, I'm actually have 2 more books that are coming out next year, and I'm editing another one, so I'm swamped, which means I had to stop trading. I couldn't do it all.
Sure.
And that was I either trade or you write. So when I had more time, I would tend to, my schedule changed a little. I would trade in the morning and then write in the afternoon. But now I'm back to full-time writing.
Well, that was going to be my next question, was where do you fit the trading in? And that makes sense. And I think that's what's nice about trading. It's one of the things we've taught for a long time. It's just that it's something that you can do. It's not something that you have to do. It's something that you can do. And it's certainly something you can fit in with a full-time job. You can certainly do that, but you have to kind of adapt your trading to your situation. And sometimes you just don't trade at all. And that makes total sense. So before we go on, one more question here, because you brought up the idea of you were an investor and then you began trading. And one of the things that I've seen over the years, Michael, is that people, and this, maybe you can speak to this, and I think you probably can, that people tend to get those confused. Maybe they enter a stock or something and they think to themselves, oh, this is going to be a great trade, and then the stock may turn against them and then they can't bring themselves to sell it. So they just end up becoming an investor in that stock. Can you talk about the 2 different hats or the 2 different activities of investing and trading and how you view them as being different?
Yeah, as any experienced trader knows, you must separate the 2. What happens when you start becoming an investor, we call it a stuck holder. You're a trader who is stuck holding that.
Right.
That's how you have to know the difference. So when I say investing, that means that's a longer term, not forever, but a longer term, let's say an index fund that you buy and you hold, and you buy it and you're not trading it. You're not hopefully even looking at it that much. You don't worry about the short-term fluctuations. That's the investor. It's a long-term view. That you have to separate that. And I believe everybody should start off as an investor to at least get their feet wet, and then you can move into stocks. And if you want to trade, that is a whole different mindset. And you're right. The biggest problem that people have is they start taking losses on a position, and instead of following the one rule, cutting your losses, and they hold and they become the stock holder. They end up saying, oh, it'll come back. Oh, if I hold it for another month.
Oh, yeah.
Now, that can work with stocks. I promise you it doesn't work with options, but options have a limited time. That's what makes them a little riskier. They expire. So you don't have that time to let it ride like you do as a stock trader. So you really do need psychologically to separate the 2 and know who you are. And, if you end up being stuck holding things that you shouldn't be holding, then you really have to have a talk with yourself and change that behavior.
Yeah, absolutely. I mean, I remember several years ago, I had taken on a trade and it went south and I just couldn't bring myself to sell it. It was one of those things where, hey, it has to go back up. There's no way this thing is going to go to zero. And I sat and sat and sat and it just didn't do anything. And I finally, in fact, my wife, told me, she said, well, you're always belly aching about this position. Why don't you just dump it? Why don't you just sell it? And I finally, I decided to keep my own rules. I broke my own rule in this case. And I said, I should have sold it. I broke my rule. I should have sold it. So I went ahead and sold it. And it was amazing, Michael, that the confidence came back. Every time I opened my brokerage account, I didn't see that nasty, 60% loss. And sometimes you've just got to take it. If you fail to keep your rules, you just got to go back in and just do it, because otherwise it's going to psychologically hamper you and it's going to hurt your future trades, because once you break the rule one time, it's easier to break it again and again and again. So that's really good feedback. Now, for those in the audience who have never even considered trading options, they're hearing us talk about options trading and all of this. Again, can you briefly explain what that is to the average person out there who maybe has never traded an option? They may not even know what we're talking about at this point, because most people are very familiar with stocks. You buy Apple stock at 100 and it goes up to 150. And then if you want to trade that, well, hey, you made money, you flip it. They know how to flip houses. They know how to flip, stocks. That all makes sense to their minds. But when you trade options, what is that? How do you define that?
Okay, that's a great question, and I'll try to simplify it. Of course, when I write it, it's a lot easier, but basically, I would say the story I would give is, let's say you want to buy a house. And first of all, you can buy or sell options. So let's say there's a house for $100,000, and you come and you want to buy that house. Let's say instead of buying the house and paying the full $100,000, you instead want to buy an option on that house. And basically you go to the owner and say, I'd like to have an option to buy it. It means I'm not going to buy it, but I have the right to buy the stock. I'm not obligated to buy it, but I have the right to. And so for, let's say, about $1,000 or $2,000, this person will hold the house for you for, let's say, 2 or 3 months. So I have the option to buy. It's my right to buy that house. Let's say the house goes up to $120,000 within a 2 or 3 month period. She's only holding it for 2 or 3 months. If it goes up to $120,000, that means I can buy it for $100,000, even though it's worth $120,000. So I have just made on paper $20,000. Now here's the part as a buyer that's really fascinating. I don't even have to take possession of the house. I can take that option contract, because it is a contract, a legal contract that I made with her. I can take that option contract and sell it to someone else for the $120,000. And I don't even have to buy the house at all or take possession of the house. So you just made $20,000 profit. And the key part was I didn't have to pay $100,000 for the house. I only paid $2,000. That's called the premium. Now that's the buying side. Do you want me to go into the selling side?
Please.
The selling side is the woman who owns the house. She received $2,000. And that means that is really her thing. She basically, in a way, rented out control of the house to the buyer. So the seller just sells the option and she gets the premium. She gets the $2,000. Now, when the 2 or 3 months have expired, then that person just keeps the $2,000 and she keeps the house. She owns the house and she keeps the $2,000. Now, let's flip back to the buyer side. I forgot one part. Let's say the house, instead of going to 120, it dropped to 90,000. That means there's a loss on it, okay? The 2 or 3 months go by. The house is now worth 90,000. The buyer who wanted that house, he's not going to buy that house. No more. He just walks away. So what was his loss? It was only $2,000. He didn't have to pay $100,000. He only paid $2,000, and that was it. The woman is delighted. I mean, she's not delighted that the house went to $90,000, but she got at least the $2,000, and she still holds her house. And then in 3 months, she can sell that contract to someone else. She can be the seller. So the first thing I always tell people is you got to decide, do you want to be a buyer or a seller, or some people do both.
Mm-hmm. Yeah, so the buyer has the right to buy that house because that's what the contract reads. The seller has an obligation to sell that house to that prospective buyer because that's how the contract reads. So the seller has the obligation. The buyer has the right.
You're right. Yeah, thank you for bringing that up. She must sell that house if the buyer says that I want the house. Absolutely. Mm-hmm. And thanks for bringing that up. Yeah, there's rights and there's obligations. But in the simplest form, that's really it. The great thing about options is that you're using less money to make more money if you're a buyer. As a seller, the great thing is that you're basically, even though you're obligated to sell the item, and by the way, people will use the options market to sell their stocks, just like they're selling their house. Mm-hmm. And that's a great way to bring in premium every month. A seller brings in premium, and many people do that. Now, if you convert it to the stock market, if I take Apple and I own Apple, I can keep selling what we call covered calls on Apple, and I keep bringing that income in every few months. People pay me, the option speculators pay me the money, and I keep selling those covered calls to them. And that's the great thing about the seller of calls. And if I wanted, as I said, if I wanted to buy Apple, it would not cost me as with Apple or any other stock. It doesn't cost much. But those are the good parts of options. That's why people like to do it.
Let's drill down into that just a bit. For the person who's listening to this now and they're thinking, okay, so if I wanted to go and I thought that Apple was going to go up in price, let's just use Apple stock again as an example. Apple is going to go up in price, they think. Earnings are coming up, or there's a new product coming out, or there's a management shakeup or something. And they say, I think Apple's going to be higher 6 months from now than it is now. So they could theoretically just go buy the stock. And of course, to control 100 shares, if it's $100, that would be quite a bit of money. So they would have to go and come up with that money. Now, what strategy, Michael, would the person who was using options, what strategy would they use to make money from Apple going up? What would be the simplest thing for them to do to instead of buy the stock, what would they buy in the options world?
Well, the simplest thing is to buy, there's calls and there's puts. A call means that you're long or you're bullish on the stock. It's really simple. When you really get down to it, options, even though there's a lot of theory and a lot of mathematical concepts, as I say, you don't have to know how an engine works to drive a car. It's the same with options. You don't need to know all that stuff, but calls and puts, that's all you have to do. Call, put, buy, sell. So in the case of Apple, if you were bullish, you would want to buy calls on Apple. First, I always recommend testing and practicing in a simulated program before you ever buy your first option. So we'll get that out of the way. And let's say and also if you're a beginner, you want to start small. The reason that people get into trouble with options or anything else is they bet too much money on something they don't know anything about. Take crypto, for example, but we won't go there anyway.
Right.
So let's say we'll start with one call option, which might cost, let me guess, about $3. So basically, I can buy one call option on Apple just to learn how to do it. My recommendation is use a short time frame. You have to select a time, and usually I say a minimum of 1 month. 6 months to me is way too far. So if you say 1 month, you're basically making the bet that Apple has to go up within that 1 month period. If it does go up, you can make money. If it goes down, you lose what you put in. And if one call contract of Apple would probably cost, I'd say $400, $500, maybe a little more. But that would be the risk that you're taking. So one call contract. And the other thing I say is that when you buy, you try to buy, without getting too technical, near where the price of Apple is. We call it at the money. It's a term called at the money, or slightly in the money. I hope that helps.
That does, yeah. So now you prefer, in your own trading, you prefer shorter time frames for the expiration date. So obviously these options have expiration dates. So unlike stocks where you can buy a stock and hold it forever, with an option, it's got a time frame. And one of the popular strategies out there that people may have heard of are leaps, where you're buying a contract that's, maybe 12, 24, even 36 months out in the future. It sounds like you prefer tighter time frames, shorter time frames. Explain why you prefer that as opposed to a longer time frame.
Yeah, I know a lot of people like leaps, and I know it's a very popular strategy. I didn't like leaps only. I should say I don't like them, but I just haven't used them a lot because of how much money you have to put into it. If you are saying that Apple, I'm making a bet basically based on all the analysis, a technical analysis, I'm believing Apple's going to go up within the next month or two. It's cost me less money. If I have to make that bet that Apple is going to go up in 6 months or a year, I'm thinking, why don't I just buy the stock instead of the option? Because I can lose all of my premium, all of the money I put in. That's the only reason I don't like leaps is because of how much it costs.
The cost.
And
okay.
I know that leap people can definitely make a great case for how, because there's one thing about options that a beginner may not know, and this is what makes them a little risky. If you're a buyer, now a seller is a whole different thing, but if you're a buyer, every day that goes by you lose what we call time value, and that means that if you buy a leap at 6 months, in a month the value of that option goes down. Even if the price is going up, even if Apple's going up, the time value is eating into it. So the risk of options is that you're going to lose money on the time value, and people don't realize that. So as I trade options on the buying side, I've made it tighter, like 1 month or 2 months, and I need to be right. And if you want to know the truth, and not everyone will agree with this, I need to be right within 2 weeks, and then I'm out. To answer your question before about where you got into a position and it went against you, I put in something called a time stop with options and stock. That means by a certain time, if I haven't made my money, I'm out. I don't care. I tend to be with options because I'm a weekly trader. I tend to put it by Friday. If on Friday I have not made my money, I'm out. I never hold till expiration. I just never do. I find that the time value, that the money I lose on time value is just so great that I have set time stops for stocks and options.
Okay, so that's helpful because there are so many different ways to use stops. You can, of course, use a percentage. You can use some indicator, but a time stop, we've talked about that before, and some people are familiar with that idea. That's a smart idea, I think, especially when you're dealing with options because you have that time decay that's always working against you. It's like a hot potato. You've got to get rid of this thing at some point.
Right.
Okay, so now we've talked about, so the bullish case. So if you think Apple's going to go up, then there's a way to make money there, buy a call. Now, let's talk about the other case you had brought up, selling covered calls. And I think that might sound a little intimidating to those who are not familiar, but this is one of my favorite strategies. personally. I know it's also one of yours. You had mentioned it off the air. Maybe you can describe that, because again, imagine a person who has, say Apple stock, and they want to hold the stock, but in using that illustration you had used before about a house, that person who owns Apple stock could sell the right, theoretically, to someone else to buy that stock from them and receive a premium. Talk about the selling covered call strategy.
Right. And there's two strategies with covered calls. So the first one, which not many people are familiar with, let's say you own Apple. I can't remember what Apple is at this moment. I'm looking, but let's say Apple's at 100 and you want to sell it. This is a stock you want to sell. So you say you'd like to sell it at, let's say, 102. Well, what you do is you go into the options market and what you do is you sell a covered. Covered means that you own the stock. You can sell calls. That means you don't own the stock. But if you sell a covered call, you own the underlying stock, which in this case is Apple. So you sell, let's say, one. Again, you can use from 1 to 10 or as many as you want. I'm just using one. Okay. Here's one thing that readers need to know. If you own 100 shares of Apple, then it's one call contract. If you own 1,000 shares of Apple, it's 10 contracts. If you own 500, it's 5. But in this case, let's say I own 100 shares of Apple. I sell one call contract, covered call, on it. I receive the premium. And, oh, by the way, I'm going to sell it at 102, remember? So I receive the premium for giving up that right to the speculator. And then if Apple does go to 102, it's automatically sold. I just used the options market to sell my stock. I received a premium plus the stock was sold. Other people can, if they sell a covered call, let's say at 102, and it doesn't make it to 102, that's fine. I keep the stock and I still get the premium. When you sell covered calls, the advantage is you always get that premium. And people will go to their stocks and they'll say, I'm going to sell covered calls on this and that. And it's kind of exciting to receive that premium just to own a stock.
Right. Yeah, it's pretty powerful to have a dividend-paying stock in particular that pays you a nice dividend, and then you can also sell covered calls on them. You end up with a pretty nice yield if you're right. If you end up getting sold away. Yeah, you're absolutely right. And now I know I need an editor because you keep bringing up the things that I forget about, like the dividends. Yeah, with you. So good job. Yes, when you own the stock, you get all the, you get the dividends and all the advantages of it. The only thing is when the only downside to it is that if that underlying stock does go down, then you obviously lost money on the stock, although the premium that you receive will help. The other downside that some people don't like, if you're a speculator and you own Apple and you think Apple's going to go not to 102, I know it's at a different price, but anyway, if it's not going to go to 102, but it's going to go to 110, 120, you may not like selling covered calls because by the rules of the contract, you must sell it at 102. It must be sold. When it goes to 102, the person who is the buyer has the right to buy it at 102. And usually this is on the expiration date, by the way. I hope this doesn't sound confusing to a lot of people. It may. So to summarize, you are buying for a very low amount of money with I'm hoping that you can make a lot of money. It's with a lower output of money. And if you're selling, you just are trying to get premium. And you own a stock and you just want premium. And it's not as confusing as it sounds. Mm-hmm. I'm speaking with the author of Understanding Options. It's in the second edition. His name is Michael Sincere. I encourage you to pick up a copy of his book. It's available everywhere that fine books are sold. Michael, we have a few more questions here. This is a really enjoyable conversation, and I know the audience is enjoying this. I know that they're getting a lot out of this because we've covered so many topics here on the topic of options. You had mentioned selling covered calls as a strategy that you like. Knowing what you know about options, share with us a few of the option strategies that you like besides selling covered calls. Is that your favorite strategy? Do you have other favorite strategies?
Well, I like selling covered calls when the environment is slightly bullish and not very volatile, like it is now. Covered calls actually has worked. It's been an excellent strategy. But you have to be flexible. All traders know that you have to be flexible. And so if the environment changes and becomes a lot more volatile, then you have to change with that. Then I would not be using the covered call strategy. And one thing about covered calls is it's really important is that In fact, Apple would probably not be the best stock to sell covered calls on. I know people would, but it's probably not the best. The best is the slow-moving, kind of boring stocks that move up slowly, and those are the ones that, are probably the best. So to answer your question, right now selling covered call works. As the market gets more volatile, or even if it starts going lower, then you don't want to sell covered calls. Then you want to switch. And here's another great thing about options is, as we said, you can buy calls when the market's going up. If this market turns on us, which eventually it will, one day it's going to go down for long periods, you can then buy puts, and that would be basically making money on a stock or an option going down. But to specifically answer your question, I tend to like buying options on SPY and QQQ. These are indexes. I tend to like buying them on indexes and hold them for no longer than a week. That seems to be the strategy I seem to like. It doesn't always work, but in a low volatile market like now, selling cover calls works. Buying calls and puts absolutely work when the market gets volatile. So to answer your question, it really depends on the market environment.
I own both of those ETFs, SPY and QQQ. And then my own personal strategy is to trade around them so as to amplify the return on those long-term holdings. So you own the NASDAQ 100 in your IRA for the long term, and it's just a core holding. But then you can also, because you know that investment, you can then trade around it. You could use inverse ETFs, leverage ETFs, or even options to trade around it. Okay. When it comes to trading, Michael, what are your favorite technical indicators? Because I know you've written a book, and by the way, I don't want to get the audience confused. We're focused on your book called Understanding Options, but you've written many books, and one of them is all about market indicators. I have this book as well. Fantastic book.
Great.
And I'm looking at my copy now, all underlined. You go through all of the major technical indicators, the MACD, the RSI, the moving averages. So you've done the study on those, and of course you're a trader. What are your favorite technical indicators for trading options?
Okay. For trading options and stocks, I'll say the first that everyone should learn is moving averages. That is just the basic one. They're on every chart. And the strategy that has worked for a decade is, let's take the S&P 500, the SPX. If the price of SPX is over there's three moving averages, 50, 100, and 200. Those are the three main ones. There's others, of course. But if it's over, especially the 200, the big one, you hold. You're a buy and holder. If it goes below and stays below, that's a danger sign. Actually, if it goes below the 50 and then the 100, that's a danger sign. If it goes below the 200, we're in real trouble. So I love moving averages. People use them many different ways, like as support and resistance, but just following that simple strategy. So I always am watching the 200-day moving average and the 100-day especially. And as long as SPX, or if I'm trading an individual stock, as long as it's above that moving average, then I feel pretty comfortable holding it. The other indicator that I really like and has become much more interested in is RSI, the relative strength indicator. That tells you when a stock or index is overbought or oversold. I specifically like it with the S&P 500. Fascinating, but it's now at an overbought level. The way it works is it's an oscillator, but if it goes 30 or below, it means oversold. If it goes 70 or above, it's overbought. Here's the trick that I've learned. I use it on a weekly, not on the daily, but I found the weekly chart gives a really strong signal. And by the way, SPX has been around 70 for the last few days or so, which tells me I believe we're going to have a reversal. It's not 100% accurate. It's not used for timing, but boy, it sure gives a good red flag. So I use RSI, moving averages, and the third one is the MACD. And I was fortunate enough to be able to interview him, the creator of MACD.
Oh,
and that
Appel.
one,
Gerald Appel.
Appel.
Yeah.
In fact, in the book, I was able to reach quite a few of the people who owned them. And the fascinating thing when I talked to them is they always said that use the indicator. They indicate. They don't dictate. They don't tell you what to do. So use your own judgment with them. And like with the overbought, oversold, just because a stock or an index gets overbought, you don't immediately run out and sell it. It can get more overbought. So that is just use it as a guideline. But the MACD is great too. That's also on any chart that you bring up. It shows up on the bottom. And lately, now this is probably a very important clue to a lot of people. If the environment is low volatile, many of these indicators don't work. MACD for weeks has not worked, and they have to be aware that they're not the answer to all your dreams. They are just indicators. So low volatile markets negate many of these indicators. RSI has been working, but I will say MACD has not lately.
Yeah, and MACD just tends to be a lagging indicator anyway. Even though it's very powerful, you're right. When the market is not volatile, or if you don't have a lot of movement, it can get stranded or stuck. And then what I found to be helpful, Michael, is to change the settings on them too. I tend to have settings for different types of markets. So when we're in a rip-roaring uptrend, I may use a particular setting with these indicators. When we're in a different kind of environment, just kind of tweaking those and back testing those has been powerful for me, personally. That's really interesting. Okay, so
that's great.
RSI, MACD, and moving averages. I got to fully agree with all of that. That's fantastic. Okay, we've talked a lot about the benefits or the power of trading options, but there's obviously pitfalls. There's obviously risks involved. Can we talk about some of the risks that you've seen as an options trader? You've obviously talked to a lot of readers who've read your book. I'm sure you've heard many stories, good and bad. Do you have any risk management tips for people who are getting involved in the option space? What are some of the pitfalls and mistakes you've seen?
Sure. Since I've made about every mistake you could possibly make.
Yeah, me too.
It's amazing. So the main pitfall with options is you think you got the holy grail there. You think you have found the answer, because for $1,000 investment, you can make $10,000 and quickly, and it's wonderful. So the first mistake that people make is they bet too much money in it. Remember I said one contract? Keep it small, especially if you're a beginner. Only trade one or two contracts. It sounds like, I'm only putting in $800, but you're putting in $800 and you could and potentially make $2,000 or $3,000. But you have to remember that you could lose that $800 or even $400 of it, because you're not going to allow yourself to lose that much, hopefully. So the first rule is don't put in too much money. And it can take a year, to really learn options. So be patient with that. The second thing is what you had talked about earlier is cutting losses. We just, as humans, we don't want to admit we're wrong, or we keep having hope that's going to come back. And with options, you don't have that opportunity. It's with stocks, there's always a chance it will come back in 6 months or a year. With options, because they expire, you don't have that chance. You have to get out, and that's why, of course, the time stop. So cutting losses, not putting too much money. The biggest problem that people have, which is with both, is that they turn from trading to gambling, and they don't realize it. And how do you know you're doing it? Instead of putting in 1,000, you're putting in 10,000 or 20,000, 100,000. Because, wow, if you can make 50% of your money in a week, why not put in 100,000? But it just doesn't work out. You really need to be disciplined. We always talk about discipline. That's discipline, meaning that you limit how much. You always think of how much can I lose? How much can I lose? Whenever you enter into when you're buying, with selling, remember, you're receiving premium. But when you're buying, when you're speculating, you have to know how much you can lose. You have to figure out how much your portfolio you can risk. Many people say don't risk more than 1% of your portfolio. That may be all the money you have. But again, if all you have is, let's say, $1,000 to your name, you can trade options, but just do it with one contract and use it as a learning experience. Those are the main risks. Like, people don't cut losses and they overbet and they turn into gamblers. That's always a problem.
Do you recommend paper trading strategies before you use real money?
Oh, yeah, absolutely. As I mentioned, I wrote pretty much a book on it. The follow-up book is using paper money strategies. Absolutely. When I talk to professional option traders who go to firms, they don't even let them make a real trade for a year. They make them practice for 1 year, similar to a pilot. You want a pilot to go in your plane without practicing for months and years? No, you need to practice under all conditions. And it may seem boring to, not use real money, but it really will further your education. Not only do I believe in paper money, I believe in the paper money programs to find you winning stocks.
Mm-hmm. Michael,
but that would be a whole book to explain.
That would. Michael, it has been it has been a real delight having you on the broadcast today. I hope we can have you back on the show again sometime and in the future. And in our final moments, would you please share with our audience how they can connect with you online, learn more about your work, get your books, all of that?
Oh, great. Thanks so much. My website is michaelsincere.com, www.michaelsincere.com. I'm also MarketWatch columnist. In fact, I have a column coming out on one of those indicators I mentioned. I won't say which one, but that's coming out in a week or two.
Nice.
So at MarketWatch.com you can find me, but my website, michaelsincere.com.
Fantastic. MichaelSincere.com. You can find his books right there on his website. Michael, again, what a great pleasure today. What a great conversation. I know the folks enjoyed it. Thanks again for your time.
Oh, thank you, Jerry. I really enjoyed it, and you did a great job of presenting all the material. Thanks so much.
Thank you. Thank you.